Hi, I'm Stephen Krasowski, Communications Manager at RMA. Welcome to RMA's annual risk conference breakout session, Proactive Credit Risk Management During COVID-19. Our presenters are Peter Cherpack, Executive Vice President and Senior Director of Credit Technology, Lou Dunham, Senior Vice President and Senior Director of Risk Management Consulting at Ardmore Banking Advisors, and Walter Shields, Executive Vice President and Director of Credit Review at BankUnited. Today, you will learn how to prioritize potential risks associated with certain portfolio segments affected by COVID-19 and the types of metrics to apply to effectively risk rate loans in this environment, using BankUnited's response to the COVID-19 pandemic's impact on certain segments in its portfolio as a case study.
Thanks, Steve, and thanks to RMA for putting on this presentation with us, as always. Hope all you attendees are enjoying the conference so far, and we're about to start our presentation. Ardmore, as a consulting firm and as a provider of third line of defense outsourced services, has the benefit of working with a number of financial institutions and being involved in what they're doing relating to the financial crisis that we're dealing with today. Thanks to that experience, we're able to share with you some best practices that are evolving, as well as stories from real banks and what they're doing to combat this challenge. So this presentation is a case study with one of our clients, BankUnited, and they'll be talking about what they did to face this challenge, how they motivated their people, how they deployed resources, and some of the best practices that they utilized to meet the challenge. So to start, Lou, I'll turn it over to you to talk to Walter about what they did.
Thanks, Peter. This case study deals with the challenges that BankUnited and their credit review department faced as the COVID crisis surfaced. So this conversation with Walter, I think you'll find very interesting. It's going to contain the role of the bank's loan and credit review department during this really unprecedented economic time. And we're going to look at what happens with the economic turndowns, the traditional credit risk management tools that they were using, and techniques that didn't really apply now that we've been in a circumstance that hasn't ever happened to the banking industry before. So we wanted to see what was going to be effective. The loan review management recognized that they needed to consider new alternatives and act in a quick and deliberate way in order to be successful in protecting the bank and its shareholders during, again, an unprecedented time. The traditional three lines of credit defense against quickly elevating credit risk. We wanted to see how that was going to work and prevent the credit impact of the new coronavirus and its consequences. This presentation looks in detail at how BankUnited credit review team responded to those challenges of the pandemic that induced a economic crisis countrywide. So without any further ado, let's take a look at the challenges BKU and their credit review department faced as COVID-19 surfaced. Walter, welcome. It's great to see you. What were kind of the first steps, Walter, that BankUnited Credit Management took as the crisis evolved in March?
So first, Lou, thanks very much. Peter, thanks very much. Thanks also to RMA for having us here for this case study. It's a welcome opportunity. A couple of things. First, covering off on what the bank did, and then a little bit on what credit review did in response to the pandemic. We benefit from an institution as having a pretty robust analytics group. So we did some high-level triage, slicing and dicing of the portfolios, looking for the most vulnerable segments of the portfolios, and putting together action plans within the first and second lines of defense to address issues with borrowers and industry segments. So one thing the bank did. Credit review at the same time also responded. Again, we benefit from having a pretty robust, well-developed data analytics function. So we did our own slicing and dicing. We reacted to what the bank had determined, largely based upon the level of deferrals and the types of risk rating changes that we were expecting to see. So we looked at the process, we looked at our people, we established what we call our triage plan in response to the pandemic.
Sounds like quite a bit there. Did you require, Walter, a new borrower analysis process? And if so, what did you do differently?
So essentially everything that we had done, or most of what we had done in the past, when you evaluate risk ratings and commercial credit, including CRE, changed. We didn't have the benefit of as much data information as we would like, certainly historic information based upon trending that we could utilize for our reviews and do things in more conventional ways. There was a lack of financial information. There was lots of things happening in the environment. So it caused us to reconsider how we would evaluate and rely more subjectively on determining risk ratings, which is something we had not done that much in the past. Certainly in the past few years when the economy had been good and there really hadn't been a lot of problems out there. So it was kind of steady as she goes, but this was quite different and caused us to reinvent the way we looked at risk ratings and how we evaluated commercial credit.
Wow, it sounds like that was quite a bit. Can you describe some of those key issues and challenges by credit review, specifically due to COVID-19?
Yeah, so we had, external issues and challenges. Certainly things were fast evolving in the industry, in the environment. Trying to stay on top of those things by geography, by industry segment, by individual borrowers was a challenge. We also had a large volume of deferral requests, as it was with most financial institutions, that we had to manage through. We also had to manage through, I'm going to say, the performing part of the portfolio and some of the business as usual activities. New business, for most banks, I think largely stopped, as it did with us. That was on pause for a while we looked at the impacts of COVID-19 and what we needed to do in response. So it changed things for us. It changed things for the bank, and forced us to focus on, alternative methods and methodologies to evaluate credit.
Thanks, Walter. How did the credit review determine the course of action and what steps were going to be necessary to identify the new risks that were presented?
Yeah, and let me mention one other thing too, and maybe this is more specific to your last question. So we had quite a few people both in the bank and within credit review that did not have a lot of experience, certainly no experience in a pandemic, maybe not as much experience as we would have liked dealing with a financial crisis. So lots of additional training was required, lots of additional enhanced, quality assistance and control was required. We considered bringing in alternative third-party sources to help with some of the volume of work. So that was a big change for us. And also, again, dealing with the lack of information, maybe that's misstating it because there was so much information, but not necessarily a lot of data and financial data, which is largely what credit review and bank credit departments rely on to make determinations. Now, to your last question, which I think related to some of the challenges and how we managed through them. Again, the volume of deferrals was significant. The volume of risk rating changes was significant. We had business as usual requirements to deal with. We also have, as it is with many banks, lots of other projects in the pipeline, things that we need to work through. In particular, at our bank, we're implementing a new risk rating methodology and system that's more two-dimensional than the one that we had. So layering things like that on top of the pandemic was quite a challenge, especially given, the expectation that the allowance will need to increase, resources might become more limited. So you had financial constraints, capacity constraints, and additional work, and a big plate of work already on the pipeline. So it was very critical that we move quickly, move decisively, even given this lack of data, although an abundance of information available to us, as we sorted through the most vulnerable borrowers, the most vulnerable industries, how we prioritize the triage, customer contact, all of those kinds of things that need to happen within an environment like this. So we gathered the information, we communicated with senior leaders, we communicated with the risk committee of the board. We did what we think, all the right things to make sure that the first and second and third line of defense were aligned and operating in the same way, essentially following the same philosophy. So we reviewed our resources in credit review, we changed our plan, we hit pause, we focused more specifically on COVID-19, And we reviewed some of those changes both with senior leaders and with the board. So lots of things happened, and they all happened quite quickly over the course of, I'm going to say, March into early April.
I imagine it was quite a busy time at that point in time. So let's look at some of the specific issues that you faced and actions taken due to COVID-19 and actions taken because of the economic crisis. What were some of those key decisions that you ended up making by the senior management team and others?
So one of the big things we did was change, our review process and approach. We developed a new tool and template that allowed us to more specifically focus on risk ratings, risk, levels of risk, expectations for levels of risk on a go-forward basis, something that would incorporate, again, both the external and internal resources available to us to make those determinations. We looked at augmenting the staff with a third-party vendor, bringing in some expertise and some additional resources to help us work through the process. We looked also at the regulatory perspective and how they were viewing COVID. We also considered what peer banks were doing to let us formulate our plan. We think we developed, I'm not going to say an aggressive plan, but a fairly detailed plan and approach whereby we did review all of the deferrals that came in, or at least a large sample of the deferrals that came in. We also looked at a significant volume of deferrals and risk rating changes that were outside of the norm. All of it was with the expectation that we'd put together a bank-wide report assessing the level of risk, changes in level of risk, how effectively or how well the bank had managed the COVID-19 pandemic. The analytics changed too. So we changed our tools, we changed our analytics. Year over year became irrelevant pretty quickly. It was quarter over quarter, week over week, monitoring line usage, monitoring changes in risk profile. There were lots of things happening both in the government and outside the government, whether it was restaurant closures, what happened to the airline industry, what happened to the hotel industry, plenty of things to react to. And we did all of those things. So it was really, 24/7 real-time monitoring. We've always had a pretty, again, I'll say robust monitoring function or group on the team, but it changed how we looked at things. And we took the team and we had them very much more so focused on the monitoring techniques and tools, and we provided some of that to them, help them along.
So how well did the results of that action plan work out for you?
So I guess we'd want to say it worked out really well. We provided a pretty comprehensive report to both senior leaders and the risk committee of the board that outlined how we thought the bank had responded to the pandemic. It also included several suggestions, lessons learned that we thought we could perhaps as an institution do better if this were to happen. Also things to consider on a go-forward basis, given the pandemic is apparently not going away anytime soon. At the same time that we developed a bank-wide report, we also put together a one-page snapshot summary of each line of business or portfolio in the bank, covering off on what we thought was the aggregate level of risk, credit quality in the portfolio, the adequacy of credit risk administration, and then the level of risk and direction of risk that we saw on a go-forward basis. Also really well received both by the bank and by the regulators and the external auditors. So we were happy with the way it turned out. Certainly a lot of lessons learned both for the bank and for credit review and things that we can do on a go-forward basis.
That makes perfect sense. There must have been a change in the scope of work done by credit review because of the crisis. Can you describe some of the impact on the bank from credit review's approach to the COVID-19 crisis?
Sure. One of the things, or several things came of it actually. Additional training required both within credit review and within the bank. There had not been a lot of experience and exposure of a lot of people, certainly again, to a pandemic or anything close to a pandemic. So more training, in particular on the regulatory perspective, whether it's risk ratings, accrual status. We haven't talked in terms of doubtful loans in a long time. We started to get that word into the conversation where it had not been prior to. We also looked at amending, and this is a work in process, our approach towards evaluating problem credits and having discussions in the documents that we used. Some of the conventional tools, again, on the business side are probably not appropriate at this time. Criticized asset reports tend to be lengthy. The meetings to review them tend to be lengthy. If we would just layer on all the additional problem assets that came to be, the meetings would go on. I'm not going to say forever, but for a very long time, and that's not practical. So we're looking at more short form, expedited ways to review problem credits, focused on strategies and risk ratings. We're also looking at ways to do more real-time analysis outside of the bank, using third-party vendors and data on a more real-time basis. So that if this were to occur again, we'd have another avenue or opportunity, something else to look at versus just looking internally and using our own data analytics team. I think as you know and others know, you only get information from borrowers over certain time periods at certain points in time. And generally, when a pandemic hits, it's stale. But sometimes external sources have access to more real-time data and alternative ways to evaluate credit quality. So we're looking at those things. The other thing, and the last thing probably, and it gets back to training and oversight, is making sure that we have robust quality control processes in the bank, that there's good evidence of effective challenge in the bank, that the second line of defense is obvious. I'm not suggesting that it wasn't, but from a regulatory perspective, it's pretty key and critical that we understand that our first line makes some determinations, they make some recommendations. The second line might come in then and make an alternative recommendation, have suggestions, and maybe there's a change that comes of all of that. We think it's important to have those things documented.
It makes perfect sense. How did the bank leverage third parties, including Ardmore for that matter, and did that affect the results for you?
So the only third party we utilized was Ardmore, and we'll probably talk, to Peter a little bit more about that when we get to that segment of the presentation. It was important to us to have a third party available to us to help us with the work, people who had the expertise and the tools and the understanding that would supplement the staff as required. We had this as a contingency, and it proved to be something that was well worthwhile. And I think we'll spend a little more time talking about, why we selected Ardmore and what some of the results of the partnership have been.
So from your perspective, what are the next steps for BKU credit review, and what were the lessons that you all learned?
Well, the next steps for us are to continue to focus on the pandemic, looking at either better, different, alternative, or maybe the same ways of evaluating credit. More financial information is becoming available, so that gives us a little more data points that we can look at. Things have settled down to some degree in certain segments of the portfolio. Areas where the risk is more obvious, for example, CRE, franchise, restaurant, leisure, travel, entertainment, so we're focused on those things. We're putting less focus on, the stronger borrowers in the portfolio where the threats are not as imminent or as significant. So we're more focused than we might have been on what we're going to do. We're going to continue with our one-page summary on a quarterly basis for the foreseeable future because we do think it adds a lot of value. It's not only added value from our perspective, but we also think from the bank's perspective, and it's increased the level of coordination and communication amongst credit review and the line. So we're going to continue with the program as we outlined it, with maybe some slight amendments, but we're pretty pleased again, so we think it's fairly effective.
Thanks, Walter. We talked about automation a little bit, so we're going to turn this over to let Peter Cherpack, who helped you on that sector, chat about that side.
Thanks, Lou and Walter. Very interesting discussion. I think the story of quick, decisive action shows that it pays off. And whereas some institutions who've chosen to kick the can down the road may be looking a little behind the eight ball when it comes to what they're going to do next. So let's talk a little bit about the technology and the automation that BKU chose. Walter, why did BKU choose to move from their internal credit reviews automation to a fully automated external loan review tool? Can you talk a little bit about decision making?
Okay, so as it is with most loan or credit review departments, we have a tool that we utilize for evaluating credit quality, looking at individual borrowers, trying to aggregate the review results and then present them in a meaningful way in a report. We found that our tool was a bit, I'm going to say, archaic / outdated. It was homegrown. It was developed about 6 or 7 years ago. It was developed with the help of IT. Internal resources and the time that would be required to make the changes that we thought were necessary would have been too significant. So based upon that, we started to look for third-party solutions and went through a process of interviewing, identifying, several people who provided tools related to credit risk review and how to do credit risk review most effectively. Ultimately, we centered on Ardmore and Mylar because they had not only a tool that had been proven, they've used it for several years, made refinements over time, but they also had credit expertise, things that we could bring in, and we ultimately did bring in to help us, I'm going to say in a pinch or in a crunch, when we needed extra, people power to get the job done. So it was both, the systems, the tools, technology, was also, having that ability to bring in some expert, third-party help as and when required. And also we found Ardmore to be flexible. They did have a product off the shelf, one that they've utilized over time. Again, tried and true, but we wanted to make some changes and adjustments, and we did that, and we did those things with Ardmore's help.
Great. Well, I appreciate the comments and appreciate you sharing your thoughts on that. Well, you go ahead and you did it. You converted over to the automated workflow. What were the benefits? How did it work out, and what were the benefits to the bank?
Yeah, so we think it's worked out really well. We were able to get up and running pretty quickly on the initial, I'm going to say Ardmore tool and template. One of the bigger benefits or biggest benefits to us is, when the pandemic hit, we needed to do something differently, as I mentioned in the earlier part of the presentation. And we worked with Ardmore to come up with a short form evaluation approach, a new tool, a new template that would allow us to more specifically focus on risk ratings. Risk ratings as we determine them, consistent with regulatory expectations, and also the level and support provided by the line to what they did. So Ardmore was very flexible and continues to be flexible in working with us to provide new tools and approaches, and we utilized that. And it's allowed us to do something else that we hadn't done before. We had, again, a fairly cumbersome, not really user-friendly system in place. The reports that were generated, including what we call the borrower worksheets, were not user-friendly. They were not really made for prime time. Ardmore has a prime time report that we can print and share with our business partners so they understand very specifically where we're coming from and why we made the conclusions that we did. And that's really been well received. Very transparent, and a very good tool to have available to a credit review department.
Well, that's great. I know that we enjoyed working with the bank. The innovation that we were able to put together to help solve the problems and move swiftly because we knew this was going to happen quickly and had to get done. Also, I remember you being sort of excited when you realized that managing work at home loan review was going to be a lot easier because you now had an automated system that allowed you to view in real time what was going on with your staff. The timing seemed to work out pretty well for that.
Yeah, it all came together nicely. So, we did not have in our prior tool workflow management techniques. We didn't have robust reporting. We have that now. Productivity is always key and critical. The quality of work is always key and critical. Doing things on a remote basis makes it even more challenging. And using the tool, and when we use it effectively, that really helps us in those areas.
Great. Well, can you tell us a little bit more about the lessons you learned about selecting a loan review automation partner. What seemed to be the most important thing and how it worked out for you in this case?
Yeah, so amongst the things we were considering were creativity, flexibility, financial strength, stability, experience in the field and in the market. We looked again at many vendors and found that Ardmore, met all of our criteria. So we're happy with that decision. We need to have quick turnaround time. We saw that when we developed a new template for doing criticized loan reviews out of the pandemic. Allows us to supplement, skill sets, ready to go folks on the ground or close to the ground that we can bring in and help us, and that all happened. A vendor that has, foresight, experience, creativity, and flexibility, all of the things that are important to us. And cost is also a consideration, and that was part of the dynamic as we made our evaluation. And we found that, Ardmore, from our perspective, was, cost benefit, I'm going to say wise, a good alternative or solution, again, to doing something internally, which would have taken much longer and probably cost more money, or potentially what some of the third-party providers were going to charge us for similar services.
Well, thank you, Walter. And, I think it's a partnership. Ardmore appreciates BankUnited's approach and, candor and willingness to work with us. It's as much a partnership and the contributions of BankUnited as it is Ardmore's work that made this work out so successfully.
Yeah, we would agree.
And thank you, Walter, for your comments throughout. This concludes the presentation of the case study today. I'd just like to take the opportunity to thank BankUnited, Walter, and the staff. Also, thanks for your questions throughout and for your attendance today. Hopefully, the comments from Walter and ours helped give you some ideas about some of the evolving best practices during this really unusual time. So thank you, and thanks to RMA for allowing us to do this presentation.
Thank you, Peter, Lou, and Walter. This concludes RMA's annual risk management conference session, Proactive Credit Risk Management During COVID-19. Our presenters will remain online for a few more minutes to answer your questions.